Hello, everybody, and welcome to the Nasdaq Dorsey Wright podcast for September 27th, 2021. I'm Jay Gragnani. Here joining me this week is Ian Saunders. And hard to believe we're here at the end of September, just a few trading days left in the month of September. And I think a lot of investors out there will welcome a turn of the calendar to the month of October, as is typically the case. I mean, we've talked on these podcasts before. September typically is the worst year on record for the S&P 500. It has not disappointed so far this year. Nothing major from a decline perspective. You saw the market pull back a bit early on in the month after hitting a new high on the just in the first couple trading days of September. Market pullback has seemed to find some support, recover here over the past couple of weeks, and we haven't clawed back all of the gains in September as we're recording this through last Friday's action. The S&P 500 is still down about 1.5% so far for the month, with just a few trading sessions left to go. So we'll see. So, I mean, from that perspective, in a lot of ways, you've seen, very, very typical month of September that has seen a bit of volatility come back into the market, which is very often the case around this time of year. But certainly this September has been arguably very different than many past, just in a lot of different respects. And so what we wanted to do today is dig in a little bit in terms of, some pretty notable changes, pretty notable breakouts from a couple areas. One being the interest rate picture. The inflationary story continues to shine through and continues to come out as we see more and more numbers, as we can continue to see new economic data come out month after month that seemingly continues to point towards prices increasing, inflationary rising. And we've seen that most recently too as it relates to just interest rates. If you look at a chart of the 10-year yield index, so TNX is a chart of the 10-year yield index. After rallying pretty sharply early in the year, the yields got up to 1.7, about 1.7% on the 10-year. Over the course of the past couple months and really through summer, interest rates consolidated. They pulled back, they consolidated a bit, and developed some pretty notable resistance on the chart. And just recently, as a matter of fact, just last week, we've seen that chart, the TNX chart, break out to the upside for the first time in a while with the move to 1.4. And as we're recording this on Friday, interest rates have gone back up and actually touched 1.5% on the 10-year yield index. So still relative to just historical interest rates are still relatively low. However, we certainly have seen those increase. I mean, you go back even just a year ago, 12 months ago, and we were looking at interest rates below 1%. So, we've certainly come a long way. But for all accounts, interest rates remain low, but certainly the trend of those interest rates has turned positive, and the trend of those rates, moving higher. And so, Ian, that just, begs the question as we look out at the markets and you look at all of the news that's out there, you look at all of the, inflationary data that's out there, you look at the fact that interest rates are rising, and, then you look at, what areas of the market tend to hold up better, tend to be pretty decent inflationary hedges. Certainly bonds wouldn't be an area. As interest rates rise, bonds are going to be negatively impacted by that. But typically, you look at areas like equities and you look at areas like alternative assets and commodities, and those two areas tend to be pretty decent over time, pretty decent hedges against inflation. And if you kind of zero in on that and look at the commodity-related equities, that's hitting a sweet spot there between your more traditional commodities and your equity markets.
Absolutely there, Jay. And I mean, this is certainly not the first time this year we've seen interest rates try to push higher. And in looking at a trailing 90-day time frame, so looking at this most recent attempt to kind of break out and break through higher, which we ended up were able to break through last week for the 10-year, we can look at a trailing 90-day correlation between TNX and then the broad spider sector funds. I'm using those as kind of the equity sector representatives. And in doing so, we see that financials, unsurprisingly, is the most positively correlated towards the upwards movement there for treasury yields for interest rates, specifically their TNX. It not significantly, not as extremely positive correlation, but it is about 0.55 there from the correlation coefficient standpoint. Energy is going to be the second the second highest there from a broad sector standpoint, with about a 0.52 positive correlation. And those are going to be the only sectors there represented as in that trailing 90-day time frame above 0.5 from a correlation standpoint. And so in looking at some of that recent movement, we've seen obviously energy continues to sit in the last ranked position in Dolly. We've seen the energy sector move quite a bit throughout this year, kind of a roller coaster ride throughout the year, if you will, going from last to first to back to last to back higher, and now sitting back down there in that last position. We've seen a few kind of broader energy representatives hold up a little bit better from a broad fund perspective. The energy sector on the asset class group scores, for instance, didn't see as much deterioration as we did the strictly relative strength-based picture. The energy natural resources group on the asset class group scores page still sits in generally favorable score territory when compared to all 135 groups. Still not quite as high as most of the other domestic equity sectors, but as average, the average energy fund has a fund score of about 3.76. So still generally higher than we've seen in, and move throughout the year, and it's increased significantly over the course of the past few weeks here from an average score south 3.5 back above that 3.5 to that 3.76 reading now. When looking at some of the individual representatives within that energy space, though, kind of focusing on that recent move there for energy, we've seen a little bit more significant upside move from more focused energy funds, like specifically the oil and gas exploration and production ETF there from Spider, ticker XOP, has a recent fund score posting of 4.31, sitting there on 3 consecutive buy signals dating back toward the end of August. And for comparative purposes, the broader energy fund from Spider, ticker XLE, has just gotten back above that 3.0 threshold to average score 3.09, went back to a buy signal there last week, and is also pushing higher, broke a spread quadruple top there with movement last week. But we have seen a little bit more consistent move from that more kind of focused oil and gas exploration and production, the XOP. So should we continue to see energy tick a little bit higher, should the rates continue to affect as we've seen earlier this year, that area would certainly be an interesting point to continue to keep an eye out there for further improvement from a relative strength perspective, and Jay, from the absolute strength perspective we've seen.
You know, I think that's a good point, Ian, when you think about exposure to energy and how to gain exposure and ways to do it through individual stocks or funds or ETFs. You know, not all are created equal, especially in the energy space. And you think about something like an XLE, which is just the broad energy select sector Spider, that is very cap weighted in nature, and about 45% of the movement of XLE is going to be directly attributable to Exxon and Chevron. Those two companies, those two stocks make up about 45% of the movement of XLE. And that's, you know, not good, bad, or indifferent. It is what it is. It's just understanding, you know, what's underneath it there. I mean, XLE from a relative strength perspective, it's got a score above 3. It's in a positive trend. So it is considered technically sound. Is it the strongest ETF in that group? No. There's certainly ETFs and like some of the exploration areas that are stronger from a relative strength perspective. So as you're looking through some of those energy names, that is just something to keep in the back of your mind as you're evaluating some of those. I mean, the month of September, you mentioned the energy is the best performing sector on a year-to-date basis, although it has been a bit volatile, as well as financials would be the second best. So it's interesting to see that those are also the two sectors that are most highly correlated to interest rate movements themselves. Energy in the month of September was one of just 2 sectors that was actually up in the month of September. So, you know, interesting picture there as it relates to energy. But I think it's also mentioning too, it's not just the equity side of the equation. You're seeing continued strength within some of the energy related commodities, the biggest obviously being crude oil, which is now pushing back close to $75 a barrel. As we're looking at this today, crude oil pushing up above $75. Then that goes back a couple months. July was the last time we were up at $75. So that'll be interesting to watch to see if we're able to get above that July high, which was right at 75. We're just above that right now. And that certainly has, you know, downstream impacts on ETFs that utilize or gain exposure to crude oil, whether it's USO, which is the United States Oil Fund, ticker USO, that has recently broken out. Interestingly enough, that has broken out above the July highs. And so that is certainly one ETF. There's a number of different ETFs that you can utilize to gain exposure to crude oil or some of the other areas within the commodity space and energy specifically. I mean, while crude is the biggest and certainly the one that gets the most publicity, natural gas has been extremely strong as it relates to what natural gas has done this year. I mean, natural gas prices are up over 100% this year, and they're not too far off those highs from right now. So, really across the board, as you look at the energy space and the commodity theme, you're really continue to see strength in the energy equities as well as the energy commodities right now.
Absolutely.
And, again, that goes back to the idea of, interest rates moving higher, certainly around the inflationary environment. The commodities area of the market, commodities as an asset class, is something that historically has been utilized and can be utilized as an inflationary hedge. But again, so have equities, and just, on the surface, if you look at just the broad equity market, the strength specifically within energy is not going to come through as much as it otherwise would in something like the S&P 500, just because the energy weighting in that index is relatively small, about 2.5%. With that being said, though, you're still seeing, by and large, the S&P 500 is in a positive trend. We saw a pullback almost 5%. Back in September, not on a closing basis. Intraday, you got a 5% pullback, but you're continuing to see the long-term trend of these major equity indexes continue to be positive as we move forward through almost getting through the month of September and heading into the month of October here at the end of this week, which is the last month, October being the last month of what is typically known as the seasonally weak period. So it's a month that historically has brought with it some volatility, historically not as much as September, but certainly something to keep in mind and keep in the back of your head as we move into the month of October. But with that said, we'll continue to look for prevailing market wins, whether they're at our backs or in our face, as we move through this market. And we'll be sure to keep you up to date via these podcasts, via our daily equity and market report, as well as our Wednesday analyst rundown calls that take place and get recorded every Wednesday each week. So with that said, thank you as always for joining us, and look forward to talking to you next week.